Hello everyone and welcome to this lecture. We are looking at the sources of capital and we are trying to explain the various sources of capital. So as you know, capital is the money that is used to start up a business. So let's get started. So when you talk about the sources of capital, we have what we call equity capital, which is raised by selling shares of the company to investors. So what are shares? Shares are a unit ownership of a company. So when you are selling shares to investors, we are selling the ownership of the company, and in return we get what we call equity capital. Then they become partial owners, and they may receive a portion of the profits through what we call the dividends. So this is what happens when you sell shares to investors through a stock exchange. They become partial owners, and they receive a portion of the profit through dividends, uh, which is very important. And you have to know that this is the capital that has been brought into the business by these investors, and they become partial owners of the business. And then we have debt capital, which is involves the borrowing of money, uh, often through loans or bonds. They are called government bonds. We have different classes of bonds, which the company agrees to repay with interest over time. So you're getting a debt as a company. You are borrowing money, that is debt. It was you owing money to the bank, whereby you often have to go through loans or bonds. So you have to choose which one you want, but over time you have to agree to repay it back with interest over time. That's how loans work. That is debt capital. So a business can take a debt capital and use that money, and they will be able to repay it back with interest over time. And by that time, as a business, you would have gained um, gained value from getting that debt from the bank. Then we have retained earnings. This is a profits earned by a company, but they decide not to distribute them. They're not distributed as dividends, but they are kept for the business operations or expansion. This was done by Amazon around 2011, around 2008, 9, 10, 11, along those lines. What they did is that they used their profits to reinvest back in the business so that the business was attracting more growth. And right now Amazon has grown to a scope which is very big. The Amazon empire is you've revolutionized e-commerce. So what they did was using retained earnings and reinvesting them back in the business, and they were doing this for the long term. They said that it was all about the long term. The idea that they were foregoing the distribution of dividends, and they kept the business operation and for expansion, which was very important. That is retained earnings, whereby use your own profits in the business to invest back in the business for operation or the expansion of the business. Then we have venture capital. We are looking at this is the big players in the game, whereby we're looking at the startups, whereby we are looking at high growth companies. They receive funding from venture capitalists. These are people who be shedding billions and billions of dollars into the company, whereby we invest in exchange for equity, whereby they get a portion for their investment. So this is the venture capitalists who are the biggest players who invest large sums of money into the business, which is venture capital. Then we have angel investors. When you look at the angel investor, you're looking just particularly you, the sole owner of the business, whereby looking individuals who invest their own personal funds in startups or small businesses in exchange for equity. So that's what you mean by angel investor, which is you're just the angel, which is investing your own personal funds in a startup, in a business that you believe is going to grow into a big business. That's why you have to start small. That's when an angel investor is needed. Yourself putting your own personal funds in a small business because you believe in the business idea and you believe that business can grow. Then you have bank loans. As you know, these are the traditional loans from banks or financial institution, provide the common source of debt capital. We've talked about this. The benefits of taking a business loan will be able to cover your debt as a business and being able to to solve any short-term cash flow problems that you might be having in the business. So it depends whether you're borrowing for the long term or you're borrowing for the short-term loans or long-term loan. It depends, but you are going to go to the financial institutions and get the traditional way of getting a loan from banks. So this is another source of debt capital. Then we have grants and subsidies. These are given by government, whereby business receive funds from government or private organization in form of grants or subsidies. They are given to companies to incentivize production, the way to trying to boost their production output. That's how they are giving grants, whereby they have very easy tax breaks. If you look at the subsidies, they're given to companies so that you reduce the production cost so that they increase productivity. We can give example like a grant being given or subsidies being given to farmers in terms of the seeds and the fertilizers. It's a way to try to reduce the production cost or the increased productivity of their produce. That is how we look at government grants and subsidies. They are there to incentivize production and increase supply of the product that the farmer is providing. It depends with the type of business that is being given the grants or the subsidy. They can come in form of money or in form of inputs. It depends with how each business that will be receiving the funds from the government is going to be using them. Then we have crowdfunding. This is a common way of doing a source of capital, whereby we are looking at the business can raise capital from a large number of individuals through online platform, that is crowdfunding, whereby you receive funding from different businesses, and that's how you raise become a source of capital. That is crowdfunding. So it's much more easier. You can start up with a large number of individuals, maybe your friends, that can be helping you to start up a business. You can use crowdfunding, which is much more easier because it's we have to agree on the equal amount of money that you'll be contributing, at what time, at what period we'll be able to do it again. That is what we call crowdfunding. Then you have asset sale, whereby asset, as you know, is something that has a market value. So selling asset like real estate, equipment, or intellectual property can generate capital, of course, because they have a market value, and it's something that is we have a market value that you can sell and exchange it for real money that can be used to generate capital into the business. So that's an asset sale. That's whereby you look at the issue of selling usually assets that you're no longer using in the business, or there might be assets you're using in the business, but as a way to try to have generate capital, you can sell those assets. And we have the likes of real estate is something that can hold value for a long period of time. And equipment, it depends with the depreciation and the residual value of that asset. So it depends with how you are selling it and how much if it depreciated. Then you can also look at how can it generate capital for you as you sell that asset. Then you have trade credit. This is whereby a business may obtain goods or service on credit from suppliers. This is whereby we are looking at forming a core relationship with the supplier, whereby you get goods on credit, allowing them to you to use the products before payment. That's another way of doing business, but it's all reliant on the convenience. It relies on the relationship between you and the supplier. For trade credit to actually okay, there have to be an agreement between you and the supplier. Usually it's done by countries on a global economy, whereby countries can do trade credit with each other, knowing that the other country is going to repay back at a given period of time. So it's very much more important for you to know that this trade credit is a source of capital. Then looking at our summary, so each source has its advantages and disadvantages, and companies often use a combination of these to meet their capital needs. So it depends with which one we're going to choose, but each one has its own advantages and its own disadvantages. But it depends with you as a company, what kind of capital do you need. The needs of your capital are going to be able to help you decide which source of capital are you going to be using in your business. So thank you so much for watching this video, and I'll see you on the next.